Joining us in the studio now is Darby. Sean is Chief Global Equity Strategist at Jefferies. Sean, thanks for coming in.
Morning.
Right, they got it done.
Well, I think at the last minute, and it's still, I guess, the way to look at it is that the bailout money goes into an escrow account, so...
Is it enough? That's the other thing.
Well, I guess all it does is keep things being pushed out, which is the whole European mechanism of dealing with this crisis. But I think longer term, you have to take a view that Greece is probably going to make a hard default and some pretty difficult choices about whether to actually remain in the euro.
It's going to probably be a default if you agree with bondholders a certain haircut.
Well, I think getting beyond 70%, you would take the view that that's where we're going to go to eventually.
OK, well, how does this change, well, I guess the dynamics in Europe? Do we now start looking at Portugal, if people keep on mentioning that, or... You know, perhaps we can have a more subtle approach this time.
Well, I think the Troika are actually going to Portugal to meet now, and so I guess Portugal's problems in one sense are not as dynamic as Greece's, but I think to all intents and purposes, the reason they were so hard on Greece in the negotiations is they've got a whole queue of these countries now who are going to ask for the same sort of
So they're setting up a
agreement.
precedent with Greece, essentially?
That's right, and I think these changes in the term structure of the bonds is pretty much what you'll see in Portugal and presumably maybe in Ireland and even in Spain.
All right, well, what does it mean as an investor? How do you actually look at it and how does it change things there?
Well, I think the way the markets are, the equity markets are running is very much alongside the currencies. If actually the currency markets take things well and the euro rallies, that's dollar weakness, that's pretty good for the risk-on trade. And that's what we've seen in the last month. I guess markets have been very simple about how they've looked at these outcomes, and it's all been currency related. I guess where we're looking at things is that the US is probably still the best part of the global equity markets, pretty much independent to some extent from what's happening in Europe.
But I mean, the dollar, as you mentioned, continues to weaken. It's surprising how much the euro has actually held its ground.
Well, again, you didn't get another rate cut over the last week from the ECB, and we still haven't seen the outright money printing by Draghi. I guess the thing that the markets will look for now will be what's the size of the auction in Europe.
Exactly, but also what about the Fed itself? Does it do anything when it comes to printing money here, or QE3?
Well, I guess what the Fed has done is bought itself an insurance policy, and I think they've also got in mind keep the dollar weak, keep reflating the economy through that mechanism. Exports have actually held up very well in the US. So there's a competitive devaluation scenario.
I mean, that brings me on to talk about what happens next if you want to... Do you see more weakness for the dollar looking ahead? And that would, of course, affect the way that you actually allocate your assets.
Well, we've looked at the dollar in real trade-related terms, and it's close to 38-year lows. So it's actually very, very reflationary for the US. Longer term, if you look at the dynamics for natural gas in the United States, you could see the trade deficit starting to improve there, which is, I suspect, we're seeing a long-term bottom in the dollar. I wouldn't want to be short the dollar 2 to 3 years out.
Okay, you're bullish alongside on the US. You've got China, Japan, Mexico, Canada here, New Zealand, Norway. They're all amongst the countries that you kind of like. But on the bearish side, well, Australia, Germany, United Kingdom?
Well, I think two things are happening. If you look at what's happening in Korea, we've got a large build-up of inventories of capital goods, and that's not generally good for the German economy. I think that's been missed by the equity market at the moment, and certainly we think we're going to see commodity prices, particularly for base metals, coming off over the next 12 months. So that's the sort of concept for Australia.
China, of course, and when you're about talking about fine-tuning the economy, telling companies to look out for conditions in the next few weeks.
Well, I think what's happening to China is going back to its old way, which is very much either an export model, which exports are holding up quite well to the US, or to try to reorientate it to this consumer model, which has failed over the last 3 years. But fixed asset investment, I think, is still off the table.
I'm surprised you like property.
Well, I think a lot of it, bad news got in the price over the last 12 months, and pragmatism rules. You've seen a substantial bounce in some of those names over the last month.
Yeah, PetroChina as well, that's another one that you like. But just looking down the list of some of the other companies, Telenor in Norway, I mean, it's a utility effectively, isn't it?
Well, it is. It's also a currency play, and essentially the Norwegian kroner we think will still remain quite strong over the next 12 months. Very large current account surplus in Norway, and that should mean that the kroner, most of the Scandinavian currencies, will actually remain relatively robust against the dollar.
Sean, what about your top picks?
Well, I think if I was in this part of the world, I think PetroChina is one of the ones we would have. I think ultimately it's the oil substitution story for Asia. We find inflation pretty difficult when oil gets to $100 and the trade surpluses diminish. I think natural gas is going to be one of those big themes for the next 2 to 3 years, and PetroChina is one to play.
Sean, great to see you as ever.
Thank you very much.
Sean Darby there from Jefferies.